Hey guys, Chris Stout here. Today I'm going to go through what is real estate syndication. Before I do that, I'm going to tell you a quick story of how I got into real estate syndication. Over a long period of time, I've been accepting investments from investors and multiplying people's money, but it was always in the development world. It was always in the building world. And what I learned is my investors actually wanted more. They wanted to see more. They wanted longer returns. They didn't want quick, short returns. So in the development world, you build, you sell, and the next project will come along eventually. We're waiting for permits, waiting for approvals. It's always a long, drawn-out process. But as soon as the process starts, it's a very quick return. We're talking 12, 18, 24 months, and the project is over. So whenever I developed, I would take profits from projects and I would invest in my own apartments. So I've been investing in apartments for about 12 to 13 years now. One day, one of my investors said, "Hey, Chris, how do we get into your apartments?" That's for me. You stay out of that. You stay in the development. I stay in the apartments. Went home that night and I realized, I'm like, oh, wow. Maybe I should be pushing my investors into the apartment deals so I could multiply their money over a longer period of time, show better returns because it's more consistent, and then start to multiply and scale that business. It's a much more easily scalable business model. Because the hardest part of apartments is actually acquiring apartments. It's not so much in the management. There's work in the management, but the work in the management that goes into apartments is significantly less than the work that goes into development. So being that development is more hands-on and requires a lot more of attention, it's a less scalable business model. In the apartments, we're acquiring apartments over a long period of time. We could keep scaling because we could keep acquiring. Every 1,000 units that we acquire, we hire a new asset manager, and we could just keep going and going and going. So I'm going to go through a typical syndication structure. You could see what is this and how does it work? How do you get your money into a syndication deal? So I'll explain to you how I have my company set up. There will be an entity level that you could eliminate from the way I do it, but I'm going to show you the way I do it, and I'll show you how you could eliminate an entity level. So we have Stout Capital at the top. This is the head entity. All things flow to Stout Capital. Below Stout Capital, and this is the structure for one deal. One deal. Under Stout Capital is a management entity. This management entity is an entity that is owned by my company. The reason that we put a management entity between the actual ownership of the property entity and my head entity is occasionally we have co-GPs. So there would be another owner potentially of this entity. So we'll say a co-GP has 20% ownership. This GP was assigned a role, whether it be raising capital or management or some form that they work their way into the general partnership team, which there's many ways to work yourself into a general partnership team. But this is the reason I structure this in case this exists. Even if it doesn't exist, I will keep a sub entity, and it just allows me maneuvering down the line if I wanted to pull in a small partner to do something for the company. So this is a minority share. We always have Stout Capital will always have the final say in all entities that it's invested in. We won't get invested in deals that we don't have final control and say. So this would be a management entity. Management entity. The management entity will own 30% of the deed holding entity. So right below this is actually the building. This is a building. I'm not an artist. The management entity will own 30% of the deed holding entity. Okay, here's where you fit in as an investor. Of the deed holding entity, the investors collectively own 70% of it. So this investor group is made up of could look something like this. It could be 200K, 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 100, and 100. So it further breaks down into a pro rata share of individual investors that comprise of a 70% ownership. So upon closing, we actually calculate everyone's ownership percentage once we know the exact amount of money needed to close. And we could get it down to the penny at this point of how much everybody owns. Okay, Chris, how do the profits flow upstream? So between the property and the deed holding entity, there's a property manager. I should have put that in, but we don't own the property manager. Property manager takes care of all the day-to-day expenses in a property. So they take care of all the rents coming in, the property level expenses. That all happens at the property manager level. And then up from there, the net profit goes to the deed holding entity. The deed holding entity then further distributes the profits to the management company, us, and the investors, you. The investors get 70% of the profits. The management company gets 30% of the profits. There's other items you could see that you have to pay the management company over the course of the investment. Over the course of the investment, you're going to see an acquisition fee. The acquisition fee is typically 1 to 3% of the deal purchase price. There you're going to see an asset management fee, otherwise called an AM fee. Asset management fee is also between 1 and 3% of the annual rent roll, or you could say monthly rent roll, the gross rent roll. You also will see a refinance fee. A refinance fee is typically about 1%, and then a disposition fee. Disposition fee is typically 1% as well. So these fees will pass up to the management company in addition to 30% of the deal profits. So the good thing about a real estate syndication is 99% of the deals I see owned by other people, our deals perform better, and they're not doing anything. You're not doing anything in our deals. 99% of the deals that I see other people own that they're active in the investment, or they're active in the real estate, are making less money than if they would just be invested in our deals. And why is that? We're doing it full time. It's very typical that people are invested in real estate. It's a part-time gig. They're not paying attention to it 100%. We pay attention to it at management level, and we also have a professional property management company operating this. So the property management company that we have operating these deals, it's not someone in a side office who's doing it on the side. This is a professional property management team. They have project managers, full-time accountants. We have full on-site staff running these properties. It's very, very, very tightly ran. And it's ran much tighter than if you would own real estate yourself. And so by doing that, we say that earning 70% of our deal is better than owning 100% of your own deal, because we're doing more than 30% better than you would by yourself. And then the way the money gets passed up further past the management company really depends on how we have our general partnership set up, which actually has no effect on the limited partners. If we decided to take in a co-GP, that could be for many reasons. I'll cover it in another video. But Stout Capital will always be in control of the deal. So that's a syndication, a typical syndication, more simple syndication setup, very typical of most syndicators. Don't let anyone complicate it for you. This is how most of them are set up. And thanks for watching, guys.